Quickly, just wanted to bring you another Periscope today to talk about interest rates. I've been getting a lot of questions about what's happening with interest rates at the moment. And I really want to outline why you should be switching lenders and in what circumstances. So feel free to give us some hearts along the way and share the Periscope session as we go, because I think this information will be useful for a lot of people. So just going to quickly talk about credit risk and give you some background as to what's happening in the market. There's been a lot of talk about APRA and the changes they've been making or implementing, and particularly as it affects in investment lending, investors and those investment interest rates. But also want to talk about capital adequacy requirements as well. So capital adequacy requirements basically dictate how much capital that a lender must hold as a percentage of their risk-weighted assets, okay? So there's basically 5 lenders in Australia that are accredited to use what's known as an internal ratings-based approach to credit risk, and that means that they can basically calculate their own probability of default and loss given default on each loan, okay? Now, those 5 lenders are obviously the big 4, so ANZ, CBA, NAB and Westpac, and also includes Macquarie as well. Now, all the other lenders, so all the other smaller lenders, all the other lending institutions use what's called the standardised approach, which is prescribed directly by APRA. Okay, so we've got our IRB, or our internal ratings-based approach, and then we've also got our standardised approach. Okay. Now, APRA's ruled recently that for the IRB approved lenders, so that's the big 4 plus Macquarie, the average risk weight on residential mortgage exposures must increase from 16% to 25%. Okay, now what this is designed to do is narrow the difference between the average mortgage risk weights for lenders using the IRB risk weighted models and those using the standardised risk weights. Okay, so they were trying to close the gap there between the 2 different methodologies. Okay, so in other words, those 5 lenders using IRB have to increase the amount of capital they hold against their residential mortgage exposures. Okay, so basically that's their loan book. Okay, so there's a couple of ways that they can raise this capital, but as publicly listed companies, their number one priority is to its shareholders, okay, not its customers. So a lot of people get upset when interest rates increases are passed on and margins are increased, but the reality is these are publicly listed companies. Their number one priority is to their shareholders and maintaining the share price and the amount of dividends that they pay out. So that really leaves them one option, and that means to increase interest rates, okay, to increase those margins, okay. So that has been happening over the past couple of weeks, as you've probably seen. The issue is, however, they still need to go up further in order for them to meet APRA's requirements that have been set down to be met by July 2016, okay. So rates have been going up, and it looks like there's a large probability that they're going to be going up further, okay? There's already a 90 to 100 basis point difference between the big 4 and some of the other lenders in terms of interest rate. So we're looking around high 3s or low 4s with some of the smaller lenders. With the big 4, we're looking around that, after discounts, around that high 4 or 5% interest rate. Okay, and that looks like it's going to widen over the coming months, running up to July 2016, when the APRA standard has to be met. Okay, so on a $500,000 home loan, that means you'll be paying an additional $100,000 in interest over the life of the loan. Okay, now if that's something that is sounding significant to you and something you want to avoid, and if you're currently with one of those IRB accredited lenders, I definitely suggest it would be prudent to explore your options and have a look at if refinancing to one of the smaller lenders would be suitable for you, because they're the ones that are going to be unaffected by the APRA rulings. Okay, so well, it's very difficult to predict where interest rates are going to go overall. There's definitely going to be a differentiation between those IRB accredited lenders, so ANZ, CBA, NAB, Westpac and Macquarie and all other lenders. Okay, so there's already a gap there between what they're charging in terms of the interest rates, and that it really is set to widen between now and July 2016. So just wanted to give you a broad overview there without getting into too much detail, but to give you a little bit of the background of what's happening and why it's happening in regards to interest rates. If you are currently with one of those lenders and you do want to explore your options in terms of potentially switching over to one of those other lenders at a much lower interest rate, please feel free to get in touch. Send me an email, get onto the website, or give me a call. All the details are on there. Thanks very much for tuning into this quick Periscope session, and I'll hope to speak to you soon.